What's up, everyone, and welcome to the Long Game Podcast hosted by Thomas Kopelman and Jacob Turner. In each episode, you'll hear us break down financial topics that are relevant to you and your situation. Our goal is to help bring credible financial information to you in short, bite-sized episodes.
All opinions expressed on this show are for educational, informational, and entertainment purposes only. Nothing on the Long Game Podcast should be considered advice. Always consult with your team of professionals before making any decisions regarding your finances.
All right, welcome back, everyone, to another episode of the Long Game Podcast. We're here again with Blake. So go check out last episode. He's just a great resource. In the last episode, we really just talked about slats and if they really are the end-all, be-all, and the first tool everybody should think about in estate tax planning. Go back and listen. I'm not going to ruin it for you, but I think it's an episode people need to check out. But today's episode, what we're going to talk about is advanced charitable giving. And so we've hit on this a little bit. We just did some episodes on end of year tax planning. We've talked a little bit about donor advised funds, but in this episode, we're still going to talk about donor advised funds, but we're going to talk about a lot of other tools that maybe you've heard of, maybe you haven't. We're going to go into each one, kind of the benefits, the disadvantages, when they make sense, when they don't. And so Blake, when this conversation is brought up, what is the first thing that you think about?
Yeah, well, I tell you, the first thing I think about is potential tax law changes that are coming on the horizon. And I think about this because, we live in a very charitable country. I was reading about this, of how charitable we are as Americans. And we're the most charitable. We give the most money. The most percentage of Americans give money to charity than any other country in the world. It kind of makes you proud to be an American. But what's interesting is that people in America today aren't getting the tax benefits out of the gifts. And what I mean by that is when we passed the Tax Cuts and Jobs Act of 2017, we took the standard deduction and we doubled the standard deduction, which made it so that over 90% of Americans will take the standard deduction, meaning that the only way that you get benefits out of charitable gifts are if you are going to itemize your deduction. And I think, in this year for married filing jointly, I think that the standard 29.2. Yep. 29.2. So, and really they reduce the amount of itemized deductions that you can take. It's really, you're capped at $10,000 for state and local income tax. There's mortgage insurance. And then if you have medical expenses that are more than 10% of your adjusted gross income, and then there's charitable gifts. And that's really it. So for families that don't have a mortgage and are capped at $10,000, that's some pretty substantial charitable gifts that they have to make in order to be able to get the tax benefit from those gifts. Yep. Now, one thing that's definitely come and really in the last few years has come just roaring is what we call a donor advised fund. And the donor advised fund is really about the simplest vehicle that you can create that will allow you to do what we call bunching. So the idea is, hey, if I'm going to give a gift this year, it has to be a substantial gift in order for it to make sense tax-wise. So what you might do is bunch several years worth of charitable gifts in one tax year. So you create a donor advised fund, take about 3 or 4 years of charitable gifts, put in the donor advised fund, and then once it's in the donor advised fund, that's the year that you get your tax deduction. And then the assets can stay in the donor advised fund and you can trickle, the assets out over the next 3, 4, or however many years that you'd like to. Absolutely. Absolutely. So yeah, I'm definitely thinking about the tax laws because, once we go off of this cliff, we don't know what's going to happen in 2026. And we're all at the edge of our seats with the election and trying to figure it out. But if we go off the cliff, then the standard deduction gets cut back in half again, and people will be doing more and getting tax benefits out of charitable gifts. So you're just going full circle of, it's it makes me feel good as American that people are giving gifts, not getting any tax benefit out of it. But that's what I said. Yeah, they don't know that.
Rick, is people don't read their tax return. They have no idea if they take the standard deduction or itemized, so they have no idea whether they benefited from it or not. But I
Absolutely.
do love that you started with donor advised funds because, like, I would say maybe 25% of my clients have a donor advised fund, and maybe 3 to 5% have used any other tool. But the bunching does make sense, right? Because you're either going to take the deduction every year and give, or 1 year you're going to be way above the standard deduction benefit, and then the next years you're going to take the standard. So you do see a big benefit, and you get bonus points if you actually time this in high income years, right? Maybe you have a big amount of RSUs vesting in 1 year. Maybe you have a large bonus. Maybe this year in your business you did abnormally good for whatever reason and you don't expect it to continue, right? The
Mm-hmm.
best time to do this is when you're in a higher tax bracket, right? You'd much rather a deduction happen at 37% than you would for it to happen at 22%. I mean, that's just, it's just, you should know that, right? But the other thing about this too that business owners don't realize is that you can donate part of your business, right? This is something that you don't want to do every year. It's not something you want to do when you have no idea if a business sale is happening. But when you know a business sale is going to happen in the short term, it is a great thing to do, right? So maybe you started your business, you have basically zero basis, and you're going to sell it for $20 million. Maybe you want to say, I want to get all the charitable giving for the rest of my life done. I want to give $50,000 a year for the next 20 years. That's $1 million. I'm going to donate $1 million. I avoid the entire capital gain. I'm going to have plenty of AGI that year, so I'm going to get a deduction against my income in that year. I can grow that money. I can distribute it. And so, like, make sure you're thinking about this, because as soon as you have that LOI in hand, you no longer can do it and avoid the capital gain. And a lot of business owners wait till LOI or post business sale to start to think about it.
Mm-hmm.
The last thing I want to say on donor advised funds that I love about them is it gets rid of the giving to where mixed with taxes, right? So, like, when you give, most people have to say, here's how much I want to give and where. A donor advised fund allows you to just pick how much, right? I just want to do this for taxes. Later, I can figure out where to give, because I find a lot of people don't give because they don't know where, even though they want that tax benefit. And so I love that it gives you the separation and the time to figure that part out.
Yeah, and I want to talk about this in context with another tool that is very, very similar, and that's the private foundation. And honestly, as I said, the donor advised fund has really roared to prominence, in part because it is a very easy tool to use, create, and continue with. Whereas a private foundation has a lot of work that's associated with that. And so what I've seen a lot of families doing is unwinding private foundations and making distributions over and creating a new donor advised fund. So why? Well, let's think about the private foundation real quick, and I'll contrast that to what a donor advised fund is. With a private foundation, there's a lot of things that it has to do. Well, first of all, in order to establish a private foundation, you have to go to your attorney's office, and they have to either draft a trust or a corporation for you. That will be that 501c3 qualified and the like. So once that's set up, then your foundation, then as it's operating, there's a few rules that it has to play by. First of all, it has an annual required distribution of 5% of the assets that come out. It's calculated a lot like your required minimum distribution of an IRA, right? So every year 5% has to come out of that donor, or not of the donor advice fund, of the private foundation. Now the other thing is that the private foundation has to pay income taxes. It has a 2% income tax on the investment earnings, but it has to pay income taxes, and it has to file a 990 PF. That's the income tax return for the private foundation. Now, with that tax return, there's a lot of information that's divulged on that tax return. The value of the assets inside of that private foundation are on that tax return, as well as all the members, the trustees, and the board of directors and the like. Your name is plastered on there. Now, let me contrast this with a donor advised fund. A donor advised fund has no required minimum distributions at all. On top of that, there's no taxes that have to be paid from the donor advised fund. And so So administratively, in a donor advised fund, you just go to the provider and you fill out paperwork to establish your donor advised fund, right? So donor advised fund, very simple to set up, no attorney required, no outlay of any design or anything like that. Donor advised fund, no taxes. Private foundation, you have to pay taxes every year. And then on top of it, this is what's important to note, especially for the ultra high net worth families. If you create a private foundation and you distribute to a charity, the name of the family is attached to that donation, or the name of the private foundation is attached to the donation, and then people can go back and look at the 990 PF to see who the players were. Whereas a donor advised fund, gifts can be made with your name attached, or it could be made anonymously. That's huge, especially in today's world where we're in a, if someone makes a gift to some politically sensitive organization through a donor advised fund, you can assure anonymity versus a private foundation where everything is public record. You're able to be tracked where your dollars are going to, and we live in just such a crazy political climate that it just doesn't make a whole lot of sense.
That's a good point, because I wasn't thinking politics, because in my mind I was like, when I'm given money, I like my name being behind it. Like, maybe I'm selfish, but in general, like I think in my mind, I don't think there's anything wrong with having two benefits: one, feeling good about what you're doing, and two, doing it right. And so, like, I don't think I would be the person who'd be like, I just donated $10 million anonymously. But you're right, I didn't think about politics or potentially some other beliefs that you have that are like, I still want to be helpful, but I don't want like any news around me doing it. So that actually makes a lot of sense.
Yeah, and what's great about it is that you can combine the two techniques and get the best of both worlds. Because what I didn't mention is that a private foundation has two kind of neat things associated with that. Number one is that the members of the board or family members can be employed by the private foundation and receive reasonable compensation for their time and their services that they render for the organization. Now, it has to be reasonable, and as they say, pigs get fat and hogs get slaughtered, right? So you have to know what you're doing there, but also with a private foundation, you have ultimate control. The family has ultimate control of what happens to those funds. A donor advised fund, when you want to make a grant from your donor advised fund to a charity, the donor advised fund administrator, whoever that is, has the ultimate authority they can actually tell you, no, I don't want to make that grant. Now, the nice thing about a donor advised fund is that if you are trying to make a donation and the donor advised fund provider doesn't like that organization and tells you no, you can actually make a distribution from that donor advised fund to another donor advised fund at another provider that you also control, and that it's a charitable distribution. It all works, so you can eventually get there. But going back to it, the private foundation is ultimate control, and it can employ the family. So what I've seen in real life experience, probably, what was that? Probably 10 years ago now, maybe not that long, but I was working with a family that sold their business, and what they did is they combined the two strategies, and it was just brilliant. So they had about $10 million into a private foundation, and then about $85 million into a donor advised fund. Wow. And the idea was that, hey, that 5% distribution that has to come from the private foundation, well, it's just going to go right to the donor advised fund and sit and cook until they found a worthy cause to make the distributions to. And yes, the private foundation had to pay taxes and things like that, but it was a small amount when the whole was, 9 times more than was in there. And so they got the best of both worlds. They were able to make all their gifts from their donor advised fund. So their tax return it showed a small amount, and so they didn't get all of these harassing calls from charities saying, "Hey, I see you got a bunch of money. Can you make me gifts? Can you make, you know?" So it was a great tool for that family and potentially anybody, you know, in that that has that kind of wealth to play with, because at the end of the day, the private foundation was the owner of the donor advised fund, and so yeah, great opportunity, but as you sit back and you think about it, wow, private foundation sounds awesome, but it's a lot of work. And in today's world, if you don't have about 3 million or more that you're going to be able to put to use today, just do a donor advised fund.
Yeah.
And so what I see a lot of times with clients that I work with is we'll set up a donor advised fund while they're alive. And then at death, typically that's when the large funding occurs. And so we might have a donor advised fund today, but then their estate documents, their will, their trust might create a private foundation at death that then will spring to life and start acting at that time. But the two of them together can be an excellent tool. But if you're going to do one or the other, probably down the road of a donor advised fund in today's world.
Yeah, really smart. And I'm glad you said the number of 3 million, because that was gonna be my next question, is like, at what level does this start to make sense? Because I see people who talk about it of like small dollar amounts, like 250,000 or 500,000 or something. And obviously that's not tiny dollars, but it is in the foundation world. And for a lot of people, I even hear 5 million is like that entry level point. But I think moral of the story is, right, you need a lot there. You need to be willing to spend the time, right? Because you do still have to run it at least a little bit like a business. You have to be making distributions. Sure, you can make it to a donor advised fund, but in general, right, this isn't the like passive move, right? If you want passive, donate and send it to somewhere, a donor advised fund makes sense. If you are like, I'm retiring and I want to take that energy I had in running a business to be charitable and do a lot of great things, that's when a private foundation really does start to make sense. And the other time I see people who do this that are very wealthy, that they want to do this to help teach their kids, right? They're like, we grew up with a lot of money, how can I help instill good values in my kids? Great. We can basically have a charity and my kid can help run this as they grow up through high school and stuff. And they can see the impact and watch what money can do in different ways other than, just buying things.
Absolutely. I'm so glad that you brought that up, because properly done, a private foundation can be such a great tool for a family, because you create a private foundation and you staff it with your children and grandchildren and the like. And the private foundation, it has to get together regularly to conduct business, right? And so you're ensuring that you're all of your progeny is going to get together after you are gone, which is great. And then what they're going to be doing is learning how to steward money, first of all, but also doing good in the world, right? A lot of what you do and sitting on the board of directors is evaluating charities where you would like to put money into action. And so as board members, as family members, you're going out there in the community and you're seeing where could we put mom and dad's money to use in the most beneficial way to everybody involved. So it's a great way to make sure we keep the family together, but we're doing it in such a way that it teaches valuable skills and really brings you into the community and people of probably a lot different social strata than you are, and broadening you as a person and rounding you out as a human being. And so yes, absolutely, great way. And when you talk about leaving a charitable legacy, that's an excellent way you can do that and teach your children and your grandchildren how to do the same.
Perfect. Okay, cool. Maybe next is to kind of transition to some of the other tools.
Yeah.
We probably have 5-10 minutes left, so we can just briefly hit on the few other ones that people should think about.
Yeah, so absolutely. So the donor advised fund, private foundation, those are things that you've given the money away and you're not retaining any use or income or anything like that from, right? Well, there's something that is something that is very attractive in today's world. It's called a charitable remainder trust. A charitable remainder trust, the idea is that you're placing assets into trust while you are alive. You get an income stream from that trust, and then when you die, whatever's left over in the trust then goes to your favorite charity. And actually, typically what we have is the ultimate beneficiary is someone's donor advised fund or their private foundation, honestly. Yep. But so the way that these work is these are best suited for assets that have a built-in gain associated with them. And so if you're a business owner and you've got depreciated business assets, or if you have appreciated securities, I honestly, I used to, when I was down in Houston, Texas, I worked with a lot of oil execs that had a bunch of Exxon or Chevron stock that had zero basis in it, and they didn't want to sell it because they didn't want to pay the huge capital gain. A charitable remainder trust is actually a way that you can use it as a diversifier and a retirement income tool while also getting charitable benefits from it. So the idea is you can take these assets that have a big inherent tax liability built into it, place it into this charitable remainder trust. Because it's a tax qualified trust, it's able to sell those assets and then reinvest in a basket of diversified securities that then will be there to pay an income to you for the rest of your life. This can come in a lot of different forms. It's either a charitable remainder annuity trust, a CRAT, that pays a specific dollar figure every year. Then there's also what we call a charitable remainder unitrust with a U, a CRUT, that pays a specific percentage every year. Now, honestly, I was out of law school before the market crash in 2008, and so there was a stark difference. I was in the Midwest working with a lot of business owners that had a lot of depreciated assets, and even farmers that had grain that they didn't want to pay tax on when they sold it. So we created these charitable remainder trusts. Before the market crash, we were doing a lot of annuity trusts. And the idea with an annuity trust is that, hey, I'm going to get paid $5,000 a month every single month for the rest of my life. Doesn't matter what happens to the investments in there, I'm getting paid $5,000 a month. Well, the market crash happened, and these trusts kind of got underwater, and some of them have failed. And so we don't see the annuity trust very much anymore. What we see is a unitrust that pays a set percentage, because as you think about markets go up and down, the payment is going to be a percentage of what's in the trust. And so there's always going to be a percentage of assets that are going to be left in the trust.
Timeline here, there, right? It's always like a 10-year or 20-year or something, and that's how the percentage is normally dictated.
Well, yeah, that's the complications of these trusts. It's based upon your age and life expectancy and how much you can take out and what kind of a timeline you can take out. Because when you set these up, there has to be a 90% probability there'll be 10% of the original value of the assets left there at the end of the day for charity. So the idea is you put $1 million in there, the IRS says there has to be a 90% probability there'll be $100,000 left in that trust by the time you die that'll go to charity. Now it's part of the calculation to figure out how much your charitable deduction is actually the calculation and what that remaining value is worth, the present value of that remaining value. It's a little esoteric to get into, but essentially it's about 10%, let's just say. And so if you're younger and you're setting up a trust that's going to pay you out 5% a year, well, your charitable deduction isn't going to be as great because your present value of that 10% is not going to be worth a lot because there's a long runway. Whereas if you're older, then the charitable deduction will be larger because it's a lot shorter window for the eventual gift to charity. Now, I'll say these come and go. Charitable remainder trusts right now are important and impactful to families because they work well in environments where the interest rate is higher, right? So back when we had interest rates of about 0%, they didn't work. They still worked, but they just didn't have the the nice flair that we have now, that we have interest rates that are seemingly normal in the big picture. And so,
Why
go
exactly
ahead.
is that? Well, I think maybe we should explain to people where the interest rate matters.
Yeah, and it just goes back to that calculation of the present value of what your eventual gift is going to be worth. If interest rates are low, the IRS is using just these low interest rates to say how much that could grow and how much you've taken out during your lifetime. And so it doesn't grow, it gets smaller, right? If interest rates are high, well then you're going to be, your interest rates are high, you're going to take out a little bit over time, so there should be a corridor there that should grow a little bit, creating a larger income tax deduction.
Makes sense.
So,
okay.
Yeah, so these are in today's world, one way that we've seen these get a lot of press is that in IRAs, there's no such thing as a stretch IRA anymore, right? When your IRA goes to your kids, it has to be drained and the tax paid within 10 years. And so where we've seen is that you can have your charitable remainder trust be named as the beneficiary of your IRA, and then the assets can go in there and be stretched out over your beneficiary's life expectancy, which would create a lifetime income stream and also generating a charitable deduction that your estate can use on that transaction.
Really smart. Okay, last couple of minutes. Any other tools you feel like we need to talk about today?
Yeah, the brother of the charitable remainder trust is the charitable lead trust, and the charitable lead trust, that's the opposite. So that's where you're creating something that's going to benefit charity for a set number of years, and then after the years are over, then it comes back to the family. I liken that to essentially you're giving the milk away from your cow for so many years, and then the cow comes home after the end of the years are over. The problem is that those charitable lead trusts work a lot better when interest rates are higher. And so it's just like when charitable remainder trusts are hot, charitable lead trusts are not going to be, and then so vice versa. But so at the end of the day, it's trying to work with families, trying to figure out, hey, what is this gift for? Do we need any residual access to this gift? If so, then we might look at a charitable remainder trust or something of that nature. There's some other tools that can do about the same thing, give you a lifetime of income. If it's not, then we're really looking at a donor advised fund, private foundation, and honestly, while people are alive, more and less it's a donor advised fund in today's world.
Perfect. Any other ones you think to wrap up? I feel like those are the things I hear talked about and used.
Hey, if you give me time, I will fill it. But really, I think what is important for families to think about is, I've seen this with a client that I had. They were a teacher at a university, and I won't even say the state because I don't want to, anyone to identify anybody. But they were a science professor, and at death, they gave about $8 million. They inherited money and they'd saved money. They gave about $8 million to the institution that they gave their life to. And unfortunately, they just gave it to the university, and it was put in the university's general fund. And it was not placed in, she was a science professor. It was not placed in the science department at all. So needless to say, a few years later, there's a great new fancy football stadium and accompanying, locker rooms and things. And her money went to exactly the wrong spot of where she'd ever have wanted it to go. And so when I work with families, I help them to think about these gifts that they're going to make, because direct gifts to charity, yes, that can be very, very beneficial, right? But through a donor advised fund, through a private foundation, those are ways that you can endow your charity into perpetuity. And then, your board of directors, your kids, whoever it is in the donor advised fund, your private foundation, they can continue to monitor how those gifts are being used.
Yeah.
And so So at the end of the day, it's trying to find a way to help your charities in the way that you see fit, because leadership comes and goes at charities, and gentlemen's agreements are only as good as, gentlemen's agreements or handshake agreements. They're only as good as the people who want to honor them, or if they're still alive to do so. And so that's where we've seen a lot more in the estate planning world of implementation of donor advised funds and private foundations, just to make sure that those charitable dollars are going to be stewarded and going exactly to the causes that are most important and
Yeah.
cared about by that person.
And you can still make regular gifts from them. You can create automation around it. You could do every January, but it does give you a lot more benefits by doing it that way. Well, cool, Blake. We really appreciate you coming on and just sharing everything. You're going to be somebody that I know I'm going to be bringing back many times in the future. So again, thank you for the time, and everybody, we appreciate you listening. Please rate and subscribe, and tune back in next week for another great episode.